Thank God. Okay, interesting question for you, okay?
What's up?
I don't think have we talked about Blackrock before?
Like the investment
Yeah,
firm?
hedge fund. Wait.
I don't think so.
Okay. I read an article. I think this was if I say Matt Levine, that's a real guy, right?
It's possible that's a real person.
Yes, Bloomberg columnist. Okay. So here's like an interesting phenomenon that may or may not be happening. And then I don't know if it's good or bad. I'm super curious about that, okay? Ready?
Yeah.
Okay.
All right.
If I have a firm, that firm is supposed to do what it can to return profits to shareholders of said firm, right? So let's say there's a firm and I own 20% of that firm, right? I would hope that they're conducting themselves in a way that they're giving money back to me, essentially, right? They're maximizing my shareholder value, all that. Yeah, blah, 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 right?
Sure.
Yeah. Okay. Let's say we're in a really weird world, though. Let's say that I own 20% of that firm, okay? And let's say that firm makes pollution, okay? But that's part of how they make their goods and services, right?
Yeah.
Let's say that I own 4 other firms in the same city, and all of them are hurt by pollution. Is it possible that if I have a 20% stake in every business, that I might not want that first firm to operate at maximum capacity because I can enjoy higher returns from the other firms that would benefit for them not doing so? Do you understand what I'm saying?
Yeah, like essentially if you have a diversified portfolio, does that lead to you to be incentivized to sort of also balance the management of each of those businesses against each other?
So like something I read that was really interesting was that I think this was a Matt Levine article, but he was making the argument that he was spinning it in a positive way. I could say somebody could spin it in a negative way, but that basically because there are so many institutional investors that have a hand in so many different companies, it might be the case that some companies could weather worse performance for a while because them enduring worse performance might be beneficial to the other companies. Does that make sense?
Yeah, I see what you're saying. I mean, it's hard to say, right? Because I think that even institutional investors are... I don't think typically institutional investors would act this way. I mean, there are activists. It's becoming more popular, this concept of like activist investing and activist investor funds.
Sure. So to be clear, I'm not even on the activist thing. I wish I had this article, but I think the example that he gave was something along the lines of like, I think it was something, it had to do with like masking mandates or airlines or something, where like an airline might shut down, and even though that's really hurting that stock price and an individual investor might not like it, the ability for them to reduce the spread of COVID was actually so beneficial to the other companies that if you were an institutional investor that had shares in all of them, you would actually tolerate lower returns from that firm because you know it's benefiting your other investments. I think that was about the argument he was making. Yeah. Which was an interesting argument. But then I don't know, would investment firms actually act in this manner where you would tolerate lower firms where they just pull investment? Yeah, go ahead. Yeah.
I mean, it's hard to say, right? Because I think that there's probably a lot of countervailing forces that would lead that not happen too often. I mean, one is probably just the competition of capital markets and ownership, right? Because I'm imagining a scenario where, like, say JetBlue's stock is completely in the shitter because we've decided to lock down for a significantly longer period of time, and let's say that some institutional investors are saying, oh, it's actually a good thing because it's helping to some marginal degree with our other businesses. Well, then another institutional investor can come in and just say, well, we're going to take this stock at a discount and open up because ultimately you're sort of artificially deflating the value of this company, whereas we could capture the short-term and medium-term gains of just buying the stock and then pushing for an opening. That's one thing. The other thing is that I think that it's probably not the case that an institutional investor truly has that much sort of market power, right?
Like, I agree with you to some extent, but man, what is BlackRock? Yeah. Don't they manage isn't it like 50 trillion of investment? Isn't it some absurd number? How large all assets? It's a lot. BlackRock might be like 10 or okay, I'm sorry, a little. I was half an order of magnitude off. So, but they manage almost $9 trillion in assets. It's a lot, but there's also, I think, global too. So, but sure.
Yeah, I mean, it's global. Like the total, I don't know, like global sort of public security market's probably a couple $100 trillion if I had to guess.
Mm-hmm.
And so, the prospect of like the example of like airlines, for instance, right? Like having a significant enough share of every airline company to really take advantage of a strategy like that would just require so much money, and also kind of a lack of diversification. Like when you look at a lot of these companies' not balance sheets, but like their portfolio of investments, like a company like, I don't know, like Vanguard or something, right? They might manage enough equity to have 10-15% ownership in a lot of companies, but it's so diversified and it's minority stake enough that the strategy you're describing would be really hard to execute. You know what I mean?
Sure, I understand what you're saying. Like this would require one fund to own like an 80% share across a lot of, not even individual companies, but entire like markets that were competing with each other, something like that too, right?
That's right.
Because
it would require a lot more concentration.
Sure. Because when you talk about countervailing forces, let's say that somebody had mutual ownership in an airline and then something else, and the airline was returning worse performance because they wanted to maximize for some other shit. Somebody could come in, buy up another airline, capture the market, make more money, and then all the benefits are basically gone because now another airline is polluting or spreading COVID or whatever, so it doesn't make any sense, right?
Exactly. You turn your investment from like down 40% to going bankrupt, essentially,
sure,
right? Because yeah, exactly. Because then because I was thinking more of an internal view of somebody could just buy the discounted stock and prevent your strategy in the first place. But then, like you're saying as well, other companies might just say, oh, well, JetBlue's like purposefully taking a shit right now. We're going to double down because it leads to a lot higher returns, because they're basically sacrificing their volume. That volume has to go somewhere. It'll go to us,
mm-hmm.
right? And so, yeah, I think there's a lot of forces that lead to that strategy probably not working.
Sure, yeah, that makes sense.
A lot. I'm sure that the article you're referencing, I'm sure there's examples of like maybe investment firms coming out and
I don't think for the article I read, I'm pretty sure it was a hypothetical. Like he wasn't saying that like this is absolutely the strategy. He was just saying that it might be possible that companies could weather worse returns because institutional investors might see that it's a benefit to the entire market to have them do so or something. But I guess the question would be in places that have like a global wealth funds like Norway, are those shares like controlling shares? Do they vote on how those companies act or anything, or what is the structure of that?
The Norwegian global, it's called, I always fuck the name up. It's like the global, I think it's the Sovereign Wealth Fund Global, and then the Sovereign Wealth Fund Norway. The Global Fund is the big oil fund, and you can download the Excel sheet of the ownership that they have, and they'll say like, oh, we're actively managed. That's one thing that I've heard socialists say is like, it turns out governments can actively manage investments and it'll work out just fine. But the problem is it's actively managed, almost like a mutual fund is actively managed, in the sense that, yeah, like they're making buy and sell decisions. It's not just throwing an index together and, going with that. But obviously the Norwegian Wealth Fund is so incredibly well balanced and managed, and the ownership that they have, the biggest ownership stake that they have is going to be like, they own 3% of Apple. It's just this hugely horizontally distributed investment.
Mm-hmm.
And so it's, yes, they vote, and like, yes, sometimes the, politically Norwegian politicians will feel pressure and sometimes they'll vote in certain ways that the sort of politics demands in those companies, or like they might divest from a company and invest in another company.
Mm-hmm.
But typically it's it's almost like how we run the Federal Reserve here. Like usually the idea of politicizing the wealth fund in Norway is a very sensitive political topic, because most people don't feel like it's like, hey, this isn't really meant to be activist invested. It's just meant to be a national 401k, very safely.
Okay, that's really
invested.
interesting. So you're saying that in Norway, there's not like political pressure to invest or like disinvest in like certain companies based on. So okay, that's good. Interesting.
No. There absolutely is that pressure. Yeah, okay. Like far left and like far right people in Norway will make arguments like that, like, oh, we need to divest from all the oil companies in the sovereign wealth fund, or like a far right person might say like, I don't know, we need to. This is much less so in Norway, but like we need to divest from certain companies because of woke policy or something like that. But the overwhelming sort of political opinion in Norway seems to be like, hey, we don't really make very activist or politically charged investment decisions for our global wealth fund, right? Like we still are going to invest, even though Apple has all these labor rights problems, and even though fossil fuels are bad for the planet and stuff, like we're still going to invest in some of those companies because it's just the best, most well-balanced way to manage our trillions of dollars in oil wealth. But I mean, to some degree, sure, like ESG and like activist style investing is a pressure for the fund, but I don't know. It seems like it's more managed, kind of like I said, like the central bank, where it's just kind of seen as an apolitical institution, and most of the major parties kind of agree with that.
This is something. So there's an argument I got in with the who's the guy that used to be a math major and now his brain is broken on Twitter.
Not sure.
He was actually somewhat smart, which blows my fucking mind. God, somebody tell me. James Lindsay. Do you know that guy?
The British guy, right?
No, he's not. Okay, don't worry, you're not missing anything. But I got into an argument on stage with him once over ESG investing. And also, spoiler alert, I'm sure anybody that starts talking about ESG usually doesn't know anything about finance, econ, or investing. But regardless, I'm curious, in your opinion, so the countervailing forces narrative is one that I've used against ESG investing, that people will say that like, oh my God, like ESG scores are going to come and take over the fucking world and it's going to be the worst thing ever. And in my mind, I'm like, okay, well, if large institutional investors now are making bad investing decisions because they're obsessed with ESG diversity shit, wouldn't a whole bunch of capital just come in and like buy up for sale a whole bunch of stock basically that is, not so cucked to the ESG stuff?
Yeah, I mean,
or do you have an opinion on that? Yeah, go.
Yeah, I mean, that's kind of my feeling as well. I mean, the reality is that if ESG performed significantly worse, I mean, capital is very fickle, right? So, if there's opportunities to invest in other industries that are sort of structurally underinvested in because of ESG, of course, that's where capital will flow. And I think especially we have to consider what ESG means for different companies. Like it's very dynamic, right? So ESG for a company like, I don't know, like Shell or something, right? ESG for them might mean, yeah, we do like a little tiny bit of renewables investing and we report our, carbon footprint. Like we'll just tell you how much carbon we're something like that. But it's, it's not like Shell is making incredibly concerted efforts to become a renewable energy company, right? Whereas ESG for like Chase Bank might be offering, we're going to require carbon limitations for people who use us for revolver management or credit lines or anything like that, right? And so it's a very dynamic situation. But yeah, ultimately I agree that if ESG was like such a poor investment, then I mean people wouldn't really invest in it. Although it's becoming a better, there's certain like government policies and stuff that might lead to sort of transitively more ESG investing, just making renewables and like sustainability a more attractive investment. But yeah, it's not really, it's just another culture war issue, that people like Ron DeSantis and stuff just kind of latch onto, but it's really not, it's not like destroying our markets or anything like that.
Sure. All right. Was just curious. All right. Well, have fun. Be careful. Stay safe, buddy.
There you go, bud. All right. Talk to you later.